Hi, welcome to the channel. How much money should you have when you retire? This is a question that younger people especially should be asking themselves and continually throughout their lives. But whatever your age now, if we can answer this question, then at least we've got something to aim for. How much money you should have includes things like your pension pot, a rental property maybe, a stock market portfolio, or any other yield-bearing asset, but realistically does not include your own home because you've got to live there basically, unless you intend to downsize. Essentially, in older age, you need capital that generates cash. How much capital is the key, so let's get straight into it. I'm Anthony, and as always, we're talking money. Okay, first off, how much money you need by the time you retire will be determined by how much money you want to live on in retirement. How much money you should have when you retire does to a large extent depend on how much money you want to live on when you don't have a monthly salary check from your main source of income. So answering this question is a little bit like asking how long is a piece of string, but of course the accurate answer to this question is twice as long as the distance from the middle to the end. So we can actually answer it. And so it is with retirement income. But we do have a starting point and we'll start from there. The average wage in the UK is currently about £25,000. Now, out of this salary, most people have to pay for nasty things like rent and a mortgage, bills, and also pleasant things like children. At least I think they're pleasant. In retirement, some of these things hopefully reduce in cost and disappear completely, but unfortunately, so too does the income. The average retirement income in the UK is currently £15,000 after tax per year. Now, you might think that £15,000 isn't enough, but we can make the sums quite easy here because I'm just going to take the difference between the average pension and the average salary and come up with a round figure of £20,000. Now, in the UK, we are currently fortunate enough to have a state pension. Not everyone gets a full state pension, but if you've worked for 35 years and paid national insurance during that time, you should be entitled to a full state pension when you retire at 67. Currently, this is about £9,000 a year. And if you think that £9,000 is a bit measly from the government, then think again, because at current annuity rates, you would need a pension pot of approximately £180,000, which is roughly 4 times the level of national insurance paid in. Anyway, that leaves an £11,000 shortfall in order to get our £20,000 retirement income. From here, you can go two ways. You can either apply an average annuity rate, i.e. how much money you would need to put into an annuity that would pay you an extra £11,000. This is quite easy because you can get the annuity rates from the newspapers or online or from brokers or people who sell annuities. Currently, the average annuity rate at 65 is approximately 5%, less if you want inflation proofing. But anyway, at 5%, if you want £11,000, you just divide 11,000 by 5%, which gives you £220,000. But I did say there were two ways to go. Certainly £220,000 is a good starting point, as this would give you the £11,000 on top of your state pension of £9,000. Remember though that not all annuities are the same. Generally, annuities die with you and can't be passed on to the family. Other annuities can be passed on to a spouse, but the rates are lower and the rates can be greatly affected by market timing. Just look at the rates you could have got over the last 10 years compared to now. The rates in the future could still be lower. The second way is to apply the 4% rule. This rule says that you can take approximately 4% from your portfolio, however that portfolio is made up, without the worry that the overall portfolio will reduce in value or that you will run out of money during your retirement. And the reason for this is that the portfolio itself should on average grow by more than 4% per year. The exact figure is up to debate. Some say up to 7%, this being the average growth in, say, the SP 500 share index. Others are more conservative at 3%, but since it's known as the 4% rule, then we'll stick to that. And here's how it works. Add up all your investments and withdraw 4% in the first year on your retirement. You can adjust the amount in subsequent years to take into account inflation. By taking this approach, you would have a high probability that you wouldn't run out of money during a, say, 30-year retirement. So you would need about £275,000, from which 4% withdrawal gets you £11,000. So now we have two figures, one which is a flat rate annuity income, the other a higher amount, which hopefully should be index linked. The figure therefore you should be aiming for if you want a retirement of income of around £20,000 is that you should have about £220,000 to £275,000 of investments by the time you reach retirement age. Of course, you might have a company pension scheme where your employer has contributed. You may have inherited some money, or you may have a property that you can downsize from, or you have other assets that can be realised to reach this investment total. Now, if you want more than £20,000, then you simply apply the annuity rate or the 4% rule to get a new figure. So if you wanted a retirement income of, say, £30,000, then you would need investments of round about £525,000. Or if you wanted an income of £40,000, then you need investments of around £775,000. All this assuming you get the full state pension. Like I said in the beginning, the answer to how long a piece of string is twice as long as from the middle to the end. So now you can find out exactly how much you need to have the income that you want to when you come to retire. Anyway, I hope you've enjoyed this short video. If you have, hit that subscribe button, click that notification bell, and give us a thumbs up. It really helps the YouTube algorithm out as far as my channel's concerned. Anyway, I'll see you in the next video. I'm Anthony, and as always, we're talking money.